All right. Hello everyone. Welcome to my channel. In this tutorial, I want to walk you through a key concept in portfolio management, this classic risk and return formula. It might seem a bit difficult at the beginning in the first glance, but the goal of this tutorial is to break it down into small, understandable pieces. By the end, you will see exactly what it means when we say your expected return comes from a risk-free foundation, inflation, and the risk premium. Let's make it simple. All right, so now let's break it down. We can start with the right part of the equation, real risk-free rate, which is provided by the R sub RF. What does that mean? It's the return you would earn if there's no inflation and no risk. So imagine lending money to someone, knowing you will definitely get it back, and the prices won't change. So even though there is no risk, you still expect some compensation for waiting. For example, for lending to a government bond, you expect to have a 2% return. So that's like saying I'll get my money back for sure because if, for example, something happens in the worst case scenario, the government still can make more cash and by producing or issuing more money and then just returning back to you. So it's pretty secure that you definitely get back your money, but you still deserve a little more for the time that you allocated for these investments. So this is called real risk-free rate. So let's move to the next one, expected inflation. So this is how much prices are expected to rise over the next year. Think about it this way. If I lend you money today and get the same amount back next year, but prices have gone up, I can't buy as much as I could before. For example, if groceries cost 3% more next year, the same dollars won't go as far. So we add expected inflation to ensure the return compensates for that loss in purchasing power. So what is the next one? Is expected risk premium. So we still need to be rewarded for taking on extra risk. What does that mean? So, for example, because of, for example, if you wanted to invest in a company which is a brand new tech startup, definitely is more riskier than investing in a stable, established company. So, because of that added uncertainty, you might expect a higher premium. So, the higher the risk, the more return you would require. So this premium compensates you for taking that chance. So here, for example, the example is demanding an 8% premium to invest in a brand new tech startup company. So, all right. And let's get back to the left hand side of the equation. So it's the expected nominal return. So what does that expected nominal return mean? This is the total return you expect. It's a big picture. It already includes the risk-free rate, expected inflation, and the risk premium. So in other words, it's the final results when everything is combined. So if we have a 2% risk-free rate, 3% inflation, and an 8% risk premium, they multiply together to give you about a 13.6% total expected return. So that's what you would see reflected in your account after everything is said and done. So this is exactly computing. We can compute this 13.6% exactly from the right-hand side of the equation. When we know we have like 2% risk-free rate, 3% inflation, and an 8% risk premium. All right, so there are two other factors here in this equation that we wanted to highlight. So the first thing to highlight is why do we add 1 to all these terms? So basically, it's pretty simple. The 1 represents your original money. For example, if you earn a 5% return, you add 1 to 0.05, which gives you 1.05. That means your original 100% plus the 5% profits. So every dollar you start with becomes a $1.05. It's just a way to show the total growth. The other question that you might have is why we are multiplying all terms in the right-hand side of the equation rather than simply adding them together. So the reason is because each factor compounds on top of the previous one. Your original money grows from the risk-free portion, then inflation increases that total, and finally the risk premium compounds on top. So multiplying captures that cumulative effect rather than just adding percentages. So here's the example. We have $100 original money, and we have 2% risk-free rate and 3% inflation rate. So we need first to multiply $100 with the risk-free rate, which is 2%. So this gives us 102. And then we need to multiply this amount with the inflation rate, which is 3%. And this gives us 105.06. So if we simply adding them, this will be different. And I want you to compute that and put that in the comments and find the difference. And basically, this is why we wanted to multiply rather than simply adding them, to find the compounding effect. So let's solve an example together. Suppose we have real risk-free rate 2% and expected inflation 3%, and we have expected risk premium 4%. So what would be the expected nominal return? So real risk-free rate is 2%, and you want a 2% basic return for allowing someone else to use your money for 1 year. Even with no inflation and no risk, you just simply multiply $100, which is the total amount of money, times 1.02. So this is giving you $102. So this is the amount that you expect to return according to compensate the amount of time that you're waiting. So then we have expected inflation, which is 3%. So then we just need to multiply 102 times 1.03, which this giving you $105.06. So this is the amount of money you expect to receive after incorporating both real risk-free rate and expected inflation. All right, so now the expected risk premium is equal to 4%. In terms of completing the right-hand side of the equation, we just need to multiply whatever we computed so far for the real risk-free and the inflation, which it was 105.06 times 1.04, which is for the expected risk premium, and this giving us $109.26. So according to the left-hand side of the equation, we have 1 plus the nominal expected nominal return, and which is equal to the right-hand side of the equation, which is $109.26. And in terms of receiving the expected nominal return, we just needed to subtract the right-hand side of the equation with 1 or 100%. So this ends up with 9.26%. So your expected nominal return is 9.26%. So now we have a real life example, and I want you to answer this question by yourself. But I walk you through that and to try to make that simple. So imagine you're evaluating an investment opportunity. So the real risk-free rate based on a stable government bond is 1.5%. So based on whatever we have here, it's telling you that R subscript RF is equal to 1.5%, which is a risk-free rate. And then the economy is expected to have about 2.8% inflation over the next year. So inflation. So the expected inflation is equal to 2.8%. So since the company you are considering is a tech startup with some risk, you are factoring in a 6.2% risk premium. So risk premium, which is 6.2%. So based on these figures, what would be your expected nominal return? So you can simply substitute these factors in the right-hand side of the equation, and after subtracting with 1, you should be able to get the expected nominal return. So I want you to leave your answer in the comments below. So thank you so much for your listening, and please feel free to leave your questions in the comments, and I will get back to it as soon as possible. Thank you so much.